Hello, Wolf Catchers. Welcome back to the channel. Hope you guys are doing great. Hope everything's been going well with you all. So, as you can tell by the title of the video, we are going to be going over the worst three sectors of 2026 so far. So, previous video was about the best performing sectors of 2026 so far. So, we're just gonna go over the worst. Definitely leave a like, comment, subscribe if you like this type of information. We're gonna do a little deep dive into the three sectors. So as you can see here, the ticker symbols XLY, that's consumer discretionary, XLF, that's financials, XLC is communications. So let's go ahead and dive into it. So the big idea, right? So sector weakness reveals where capital has been cautious, not where it's given up, right? So this is not about avoiding sectors forever. It's about understanding what the market is questioning right now and whether that question is temporary or structural. So every year we're going to have sectors that are going to perform well, underperform based off of comparing it to whether it's the market or comparing it to other sectors, right? There's always going to be a winner. There's always going to be a loser. It's up to us to understand what the market is rewarding and why that sector isn't being rewarded. And in doing so, why aren't they being rewarded, right? And if they're not being rewarded, what could be the cause of that, right? And is it something that you could take advantage of, or if is it something that it's very problematic and you want to avoid that sector, right? So that's when you go do your deep dive, your research to see why the market is leaving this sector for dead. Why is it not getting the recognition or respect that it deserves? So this is how they are ranked currently, right, as of today's date. Um January, not January, sorry, July 9th. Get my J's mixed up. So as of July 9th, this is how the sectors have been performing, and these are the laggards, right? So XLY so far this year to date, it's down 2.19%. XLF, the financials, is up 0.34%, and XLC communications is up 3.06%. So, what a laggard is really telling you. So, number one, reveals investor caution. Underperformance shows where capital is hesitating before headlines catch up, right? So, just giving you some insight about where institutions are putting their money at, where the retail investors are looking at. That underperformance is showing that capital is leaving it, or capital is sitting on the sidelines waiting for the story to change, waiting for the environment to change to go ahead and deploy capital into that said sector. And then number two, signals real pressure points, right? So it could be rates, consumer strength, valuation, earning risk. They're all going to show up in the price action first, right? So as we all know, the saying goes, the market's a forward-looking mechanism, right? So these things are being looked at down the line, right? 6 months out, 3 months out, a year, 2 years out. Why the money isn't in that sector right now, and it's going to go to another sector that's going to give it a better return in a quicker fashion, right? So especially when you look at institutional, right? They got their quarterly reports, they got they end the year reports, especially for institutions. Their goal is to make their clients money. So they have to go ahead and make the trades, things of that nature. They don't want to be that firm or that investment branch that you missed Micron or you missed technology for the past 10 years or you missed the energy run that we had in XLE at the top of the year, right? So you're always going to be chasing alpha, right? So that's also going to be another sign, right? This sector is not winning. I need to make money. I'm charging this high expense ratio or this high investment fee for people to put their money into my fund. I need to get them returns. So I'm going to leave here to go here because everyone's pushing this up. I need to be a part of that and participate to get my fair share, right? And then number three, it concedes future opportunity, right? So this is where we go to looking at the fundamentals, right? Something like, for example, the financials, how we mentioned now, fundamentally, outside of like the credit risk and things like that, something like a JP Morgan, you look at that company or that bank and you'd be like, huh, everything so far has been structurally sound. They're one of the biggest banks in the world, have one of the best CEOs in the world, and they are, when you think of banking, you think of them top notch. Them, the Morgan Stanleys, Goldman Sachs, they're kind of like in their own cream of the crop, right? You're not going to lump them in with Bank of America or Capital One or Ally Bank. Shout out to all of them, but you're not going to lump in a JP Morgan Chase with them, right? It's just like a different caliber, different tier. So that is a company within the sector where it's like, hey, financials are kind of weak. How is JP Morgan perform? Let's go ahead and look at the big dog. If they're, performance wise in terms of stock price being undervalued, being overlooked, that could be an opportunity for you to go ahead and deploy some capital and then just give it time to go ahead and get you the returns. So let's go ahead straight with consumer discretionary. Again, down 2.19%. So consumer spending pressure, discretionary demand is the first to soften when budgets tighten. So obviously, when the economy is going through its rough patch, you got recession talk, you got the whole thing going on with the consumers being squeezed, which I personally feel like that is what's going on. But again, there's the mention of we're in a K-shaped economy, right? So the haves versus the have-nots, right? So those who have the assets, those who have the better salaries, things like that, and not just better salary alone, but those who have converted that higher earning potential and salary into acquiring assets, right? Because someone can make 200K a year and still be, check to check. But the person who's making 200K a year is acquiring assets, is watching their net worth grow quicker than their salary, those are the ones that are really, winning the game of this, what we call, I guess you could say, life in the financial sense, right? So when things are usually going bad in the economy, consumer discretionary, obviously people aren't going to go spend their money like that on Amazon or, go to the McDonald's. Even though it's a budget friendly situation, they're most likely probably going to go buy groceries to cook from home, things like that, right? So they're going to have tighter budgets and then higher for longer rates, right? So financing costs weigh on big ticket and credit driven purchases, right? So as we all know that the interest rates, they're not going to be cut this year. It's kind of been already set in stone that they're not going to be cut. And so far, it seems like there's not going to be any hikes, even though I know a couple videos back, we went to look at the Fed Watch tool. There's some probability of a rate hike. But as we know for sure, there's no rate cuts coming, right? So that's where we're in the environment higher for longer. So that just means currently where rates are at, just expect them to be there for longer. So when rates stay that way, so expect, you know, these interest rates affect everything from your credit card APR, from the interest you get on your savings account in your banks, loans, all those type of things are affected by interest rates, whether they're being moved up or moved down, right? So higher for longer is not good if you need access to credit and things like that. And inflation's eating real income, right? So we know that inflation has been very sticky. It's been hovering around that 3.5, 3.0% area. It's very stubborn, can't get it down to that 2%. There's been high speculation that that number of getting inflation down to 2% is probably going to be impossible, right? So they might just move the mandate or move the expectation up. Hey, the new normal may be just keeping inflation at 3%, right? For a long time, we've been trying to get to 2%. And as we can see, it's been years since we've been able to get there, right? It's been very, very hard to curb inflation. So inflation's eating real income, as we know. Even inflation is growing quicker than wage pay, right? Wage growth for the everyday person, right? The everyday person isn't getting more than 3% on their annual salary, right, per year. So technically, they're losing money each year. And then if they are making that, the average person doesn't have enough to even put away into a high yield savings account. That's going to, the goal is to beat inflation, and then obviously for them to be invested so they can beat inflation, right? That's the whole purpose of all these things: the high yield savings, buying your assets, things like that, is to beat inflation, right? because your money gets weaker and weaker each year. Your purchasing power lessens each year. And then spending sensitivity, right? The sector reacts faster to shifts in consumer confidence, right? So this sector is definitely gonna get beaten up. Like I said, if there's doom and gloom in the job market, if people don't feel like their dollars are buying as much as they used to be in the past, right? When people go to the grocery store and they seen the price of beef go up. Now there's multiple things that are affecting it, like how I just mentioned beef. We have the situation with the outbreak of the screw worm going on. So, but all those things do come into account and they all feed off each other, right? If it costs too much to be over here to buy this, people are going to be cutting down on streaming packages. People may not be going to certain stores anymore. People are going to step down in their shopping, whether that's for consumer staples like, their toilet paper, things like that. People are going to change brands. People are going to, again, for consumer discretionary, not buy off of Amazon anymore. They probably just go to the store instead and do that purchase, right? Some people aren't going to use or go to Chipotle or go to the McDonald's. Again, they're going to cook from home. Some people aren't going to go into Nike and buy the shoes. They're probably going to go to Walmart and buy the Walmart brand shoes off the shelf, right? Depends on what that person is willing to step down to in order to make ends meet, right? So some of the top holdings that's in consumer discretionary, when you think about the sector, you got the Amazons of the world, you got Tesla, Home Depot, McDonald's, Booking. So obviously you look at all these things. These are things people are going to spend money on. One, because it's convenience, and two, they got the extra money just to go ahead and spend it, right? So again, people are going to go buy a Tesla because you can buy any car, but if you're going to buy a Tesla, obviously there's a certain price point that comes with that. Same for Home Depot, usually viewed as a DIY type of thing, right? You making advancements in your home or repairs to your home. That's usually viewed as a discretionary type spend. It's not really a necessity or a need. You want to upgrade your kitchen, right? Same for McDonald's. The certain items, obviously, McDonald's tries to be budget friendly, but the everyday person, if you can't make it work, even though McDonald's has a $1 menu, $3 menu, all those type of things, but some people, sadly, just can't simply afford that, right? You got Booking Holdings, so they're a platform that helps you book your trips, things like vacation, stuff like that, cruises, flights, things of that nature, right? This type of platform is going to be affected by consumer discretionary having a down year, right? So again, consumer discretionary depends heavily on confidence, income, and spending power. Next, we'll go into financials, which is our rate sensitive sector, and they're currently up 0.34%, right? So back to the interest rate uncertainty, right? What the Fed is going to do with interest rates, right? That plays a big part on financials, right? Based on what they're going to do with their credit cards, what they're going to do on with their loans and their personal loans that they're giving out to the clients and the customers, right? Those interest rates movements play a big deal on how they're going to be loaning out money, right? And also too, the borrowing of money in the ecosystem, right? If rates are lower, it's cheaper to borrow money. If rates are higher, it's more expensive to borrow money, right? Even amongst each other. So you got credit risk building, right? So delinquencies, banks supposedly, for the most part, they account for these, right? Charge-offs, people not being able to make their payments. There's usually a buffer in there, but if it happens too quickly, or if they're not well prepared for it, this could become a very mounting problem very quickly, right? Of people becoming delinquent on their accounts, right? So imagine someone has a $20,000 credit card, $15,000 credit card, and for years or months, they've been eating off of that person, making just the interest payments. And then all of a sudden, they stopped making payments. So they lost the 15,000. Yeah, they made some cash in return, but if they didn't recoup that 15,000, they lost it, right? And then same thing with bank profitability pressure. So deposit costs and lending margins are going to be squeezed. And then consumer commercial loans, back to the loans, right? Loan demand and quality both track the broader economic cycle. So again, if money's cheaper to be borrowed, cheaper to acquire, Some of these rates could be more favorable, especially to the people on the higher end of the credit spectrum, right? Those who have the 700, 800, they go get more favorable rates, things like that, right? And they'll be more likely to go ahead and pursue those rates if they see interest rates are lower and that rate they're getting offered is lower. Same for homes. Even though it's kind of like a lagging indicator for the most part, by the time interest rates move for home rates to move, but a lot of people like to use that in tandem. It's just like a psychological thing. Hey, the Fed lower interest rates, that means it's cheaper to go get a home, right? Some people think like that. Just off of the thinking, that's a boon to real estate, right? People are going to flood in to buy because they're like interest rates are so low now. So those type of things feed off of each other. So top holdings for financials, you got Berkshire Hathaway, JP Morgan Chase, as we mentioned earlier, Visa, MasterCard. Those are the toll, looking at toll roads, right? Every time someone swipes their card, Visa or MasterCard is getting paid. And you got Bank of America, right? So financials reflect confidence in credit, lending, and the economic cycle, right? So financials is a very important part of our economic cycle. And if you've been paying close attention, even though they're year to date, they're a laggard. Over the past month, they're up 10%. So slowly, capital is leaving. As we mentioned before, energy was the top leading sector of the year. Then money started leaving energy, right? But I got something like financials, they're only up, what was it, 0.34%. But in the past month, they're up 10%. So money's leaving another sector or other sectors and flowing into financial slowly. When you start breaking it down on a month basis, 3 month basis, you start seeing where the capital is flowing, right? And last but not least, we got communication services, right? So this is up 3.06%. And let's break it down for you. So we got mega cap concentration here. So when we go to the next screen, you're gonna see some names that's in communication. It's always been a weird sector to me, some of the names that's in there, because if you do more of a deep dive, you kind of like, okay, I can understand why it's in communication. But I usually look at them as tech companies. So I think that's kind of where the overlay comes up and the confusion pops up too. But they are communication service companies, right? So mega cap concentration. There's a handful of platform names that drive most of the sector's moves, right? So XLC is a volatile sector, just like how XLK is volatile tech sector, right? But if things go correctly, goes right, they could perform very well, give you outsized growth, right? Same way tech does. So we got the advertising trends. Ad budgets are an early tell on broader business confidence, right? So depends on how you look at it too for ad spend. So a lot of companies, especially now with the innovation of AI and things of that nature, it's kind of like, do they really need to do as much ad spend? Only time will tell, because you got, it's the ROAS, so return on ad spend. Once those numbers and enough data comes up, probably over a 3 year, 5 year period, to actually see, are the productivity tools like the AI tools and stuff like that actually moving the needle for these companies in terms of ad spend, right? Because people are still going to spend money on, like, the Metas of the world, Google, things of that nature. But the game is going to change depending on these tools, and also how those platforms use AI and stuff like that to better um, suit and better service their customers in terms of ad spend and advertising, right? Then we got the AI spending question. So again, we're going to see on the next slide some of the companies that are in this sector. They're a big part of the CapEx spend, right? So again, when are we going to start seeing that return on CapEx spend? And also, is the return going to be worth it? Because they could be a return, but is it worthwhile, the type of return, right? That's another question. And then last but not least, streaming competition evaluation, right? So crowded streaming economics keep pressure on multiples. You're going to see also here too, there's companies that are playing in the same realm of streaming, right? So we've seen with companies like Disney, streaming is not as easy as Netflix made it seem to be, right? Or made it look out to be. We've seen every company now try to have their own streaming platform. You've seen Disney come into the fray. Apple came into it with their Apple One, or Apple TV, sorry, product. Obviously, you got Netflix now. You got Comcast. You got Peacock. You got networks like Fox has their own arm, and every company you can think of now that has some type of media influence is now branching out, trying to create their own streaming service, right? But again, it's not a Netflix made it look easy. It's not as easy as it is, right? They made it seem to be. A lot of spin that goes into it, a lot of work that goes into it to maintain it. And then you can see it kind of name like Netflix too has been beaten up terribly because you gotta be able to retain these customers, right? And also give quality content at a high clip, right? Because they're playing with the models of releasing episodes at a time, week by week. Some people love that, some people hate it. You know, it reminds me of growing up watching TV every Friday. You know, Disney dropped a movie, right? A new brand new movie. Or if you're keeping up with the show, like me, I watched Dragon Ball Z growing up. Keeping up with the show, you gotta watch it every Monday or every Tuesday at a certain time to keep up with the show. So trying to play on that to keep their subscribers there longer, right? And sometimes, you know, hey, they drop the whole season on you. Someone's gonna binge watch that season in the weekend and then cancel their subscription, right? Now you lost that person. So it's very difficult in streaming to keep these customers long term and also continue to provide value in terms of quality content. Because now we have all these apps. I have probably like 5 streaming services I could just hop on and then, not gonna lie to you, spend 10 minutes looking for something, 15 minutes, and it's like, oh, there's nothing interesting here that catches my eye. That's the type of situation that we're in as consumers. We have so much in front of us that now it's becoming so diluted that we're just like, oh, uh, you know what? I'm probably just gonna go watch YouTube, or I'm probably gonna hop on the game, or let me go read a book or do something else. They are all fighting for our eyeballs, but no one is doing enough to keep us on their platform long enough. That's what the situation is. So some of the top names in communication services, again, like I mentioned, some of the names are going to be surprising to you, like Meta is up there as a communication service. Got Google, obviously, because they have the YouTube um, portion of their business. Obviously, you have Netflix, names like Comcast, and then you got T-Mobile for mobile devices, right? So communication services is heavily influenced by a few major platform companies, right? So looking at all these, obviously we know Meta is on an immense sale so far this year. They're down, I think, over 20%. Google's been having a good year so far. Had a nice run up over the past year. Netflix been beaten down really bad. I don't pay too much attention to Comcast or T-Mobile, so I can't really tell you off the top of my head how their stock price is performing. But that's how XLC is holding up. So 3 sectors, 1 story. XLI reflects consumer pressure, spending power under strain. So XLF, that's the credit and rate uncertainty. The cost of money is in question. Again, interest rates definitely play a big portion of that story. And then XOC reflects valuation and platform concentration. A few names carrying the sector, because obviously you see those names that we mentioned earlier. So something like Google and Meta could move that whole sector, right? If they have a great year combined. And then Netflix just does subpar, that sector could be fine, right? So they have a lot of concentration and a lot of weight put on these few names to make them move. So insight we have from here is weak sectors are not always broken sectors, right? So the goal is to understand why capital is cautious and whether that weakness is temporary, structural, or an opportunity, right? So it goes back to the environment and understanding where we're at in that sector cycle, and also come up with your own thesis. What do you see? And also, it's okay to take insight, to do research, to see what analysts are saying, see what other platforms are saying, and gather your evidence, gather your information, come with your own thesis about what you feel about that sector, right? Is it something that, is it worth to nibble into? Is it worth to build a position? Something you want to completely avoid? Like for me personally, I don't really care to purchase any of these sectors, but I do like certain names within the sector, right? And me, I'm a tech bull, so like my son's portfolio is built around tech. Um, that's just how I view it. So if I was to purchase a sector, it would be XOK. But for us, we just have FNILX, which is a large cap growth. Growth technically is automatically um, greatly proportioned towards tech, so that's already built into it. But if you are going to go through doing sector investing, right? Understand why that sector is like that, right? It could just be underperformed, but does not mean it's broken, as in it's a bad investment, right? It's not its time to shine right now. That's all it is. So the question is at the side, what happens next? Can the consumer remain resilient, right? So obviously, unemployment numbers aren't looking too crazy in terms of like doom and gloom. There's that whole talk about consumers resilient. The consumer's been spending, and I think as you go deeper into again, how we said the K-shaped economy, and then also the consumers that are spending, that really their money they're spending, or are they making ends meet on credit cards? Because we also know credit card debt is at an all-time high. We've seen again delinquencies go up on certain things, so it's depending on how you break down the information, right? But again, the consumer being resilient is very important to the economy overall, right? That's what keeps us going, keeps growth happening, things of that nature, keeps things moving. And real rate uncertainty keep weighing on financials. Obviously, we know that's a yes, because as long as rates stay higher for longer, it's going to have some type of effect on the financial sector. And then once we start seeing those rates get cut, obviously becomes better for everyone. Surprisingly, a sector that is still performing well, even though with the higher for longer, is the IWM. So the small caps, they're actually still doing pretty well. I think they've also recently reached an all-time high, especially in this higher for longer um, rate situation. There's someone that benefits when rates get cut, right? And communication services regain leadership. I feel like that's a very, I'm not going to say abysmal, but I feel like that's a long shot for them to regain leadership. Um, at least in the near term, maybe 2 years out from now. But the thing is, when you look at who's gaining the story now, right? The story is all about AI, AI build out. It's all about picks and shovels. It's all about energy, infrastructure, memory, chips, cooling, all that stuff. There's nothing in there that screams communications. The only thing you can think about in communications, if you're going to talk about what's going on, for satellites in terms of like what's going on with SpaceX and all that, some type of communication devices up there, but there's nothing in XLC that's a big enough mover in there for you to be like, I'm gonna go buy the sector because of that potential thing. And even look at the fiber optic cables with GLW with Corning. If they're in communications, XOC, I'm not sure if they are, but if they were to be in there, they're not heavily weighted in there enough to even move the sector. So again, XOC is something I feel like you'll go crack it open. You pick your winners in there that you want to go ahead and ride with versus buying the whole sector. And then the last question, obviously, are these sectors weak for a reason or becoming tomorrow's opportunity? So again, that's when you go ahead, do your research. Hey, throw the charts up, look see if you're 10% off, 20% off, if we're at certain moving averages. And again, do you think it's a good buy for you, right? Based off your research. Obviously, I give my opinion on them, how I feel about the majority of them. But yeah, it's not financial advice. Obviously, do your own research and trust your thesis, right? And it's something too when you look at these situations where you're investing. Remember, it's always for the long term. It's never, a short term viewpoint on these things. You got to think in your head at least a minimum a year, 2 years, right? And that's not even long term. That's still considered short term. But some people just can't hold on to an investment more than a year or 2 years. You really start seeing the effects once you start, 4 years, 5 years, 10 years in. and you start looking back and be like, damn, my account compounded this much, or look how much growth I had just by sticking with these names, stuff like that. So that's the whole goal for it all, right? So again, study the weakness, understand the risk, look for opportunity. I do appreciate you guys stopping by and, you know, sitting down with me for a bit and chatting about this topic. Definitely looking forward to the next video to speak on the next topic with you guys. Hope you have a great day, and we'll catch you next time. Peace.